Hello, everyone. Thanks for joining this evening. Look, it feels a little bit like the world's gone crazy lately. The headlines are screaming. We're all looking at the effects of the ups and downs in our KiwiSaver balances, our investments, and separating the facts from the hype. No easy task. So, to help steer you through, we've got the team at AMP. They've invited you to join us this evening to give you an opportunity, have your questions answered, gain some actual clarity on the current uncertainty. Now, what we're going to do this evening, we're going to cover what's happening in the market, how AMP funds are positioned to navigate these market changes, and share some helpful tips for keeping your KiwiSaver account and other investments on track. A really important disclaimer before we get underway, though. The information included in this webinar is, of course, of a general nature only, and it's not financial advice. Before taking any action, you should always seek financial advice or other professional advice relevant to your personal circumstances. Now, introductions time. I am Frances Cook. I'm an independent financial journalist. I will be directing your questions to our wonderful experts this evening. You can use the questions feature in Teams. It should be on your screen right next to us. So please do make use of this time to get those burning questions off your chest and answered by our industry experts. And our panelists, now, they are going to do a better job of introducing themselves than I will. So first up, Aaron Klee, General Manager, Investment Management and Services. Aaron, tell us a bit about yourself.
Thanks, Francis. I've been with AMP for 15 years now, and my responsibilities are leading our investment management team and looking after the portfolios that all of our customers invest into. So pleasure to be here and share a few insights tonight.
And lovely to have you here as well. All right, next up, Yuval Ayal, Customer Relationship Manager. Yuval, tell us about yourself.
Oh, thank you. It's awesome to be here tonight. I've been at AMP for just over 2 years, and in my core role, I have the joy of helping our corporate partners and our customers essentially grow their wealth.
Fabulous. All right, last never least, Dipen Acharya, Senior Client Advisor. Tell us about yourself, Dipen.
Thank you, Francis. Hi, Dipen Acharya here. I've been with AMP for over 12 years, advising our clients through various market up and down over different time periods.
Fabulous. All right. Well, some really good expertise on the panel there. What we'll do, as I've said, we really want to have your questions tonight. So we've had some questions sent through ahead of time. We're going to roll through some of those, but start putting your questions into that question feature that you'll see on the Teams. And let's make sure that this is a good live session where you get all of those worries off your chest, because I can tell you what, even before we rolled the cameras, these guys were talking and they were making so much sense. So let's make the most of this time. Firstly, I think being on the front lines, Dipen and Yuval, you're hearing from customers on a daily basis. So what is going on? What are you hearing? What are people feeling?
Yeah, I'll kick it off. Great question. So even today, I was driving into work and I had 4 phone calls from customers just saying, what do I do? Do I panic? Do I change? So I think our customers are just feeling really uncertain at the moment. They're not really sure what's happening, what's going to their investments, what should they be doing. I think people are just generally feeling quite worried, especially about seeing a bit of a dip in their money. Finding it doesn't matter how old you are, what stage in life you're in, everyone's kind of feeling in the same boat. And they're just looking for reassurance at the moment of understanding of what's actually happening and what they should do. Dipen, I'm sure you're seeing something quite similar as well and hearing the same things from your customers.
Yeah, similar to Yuval, right? When the market behave the way they are behaving currently, it naturally creates a bit of uncertainty for our customers. But the key thing is, by the end of this Q&A session, customers will, be well informed about what's happening in the market, and we'll be able to help them through as well.
Yeah, absolutely. And I think it is that very natural thing, right? I mean, even in my line of work, my email inbox is filling up and getting the DMs on social media. Everyone is just wanting to know what is going on, because you see these terrifying headlines and you want to know, well, how much of that are they just trying to get me to click? How much of that is actually how worried I need to be? So Aaron, what are we seeing? What's happening around the world at the moment, and how are markets responding? What are the key facts here?
Yeah, well, everything that's going on at the moment is really stemming from the swarm of announcements from one President Donald Trump, and in relation to the trade policies, in particular the application of tariffs on goods that are exported to the United States. And this started back in February when the United States administration announced that it'll bring back manufacturing to the US. And it started with 25% tariffs on steel and aluminium, as well as car assembly and car parts, really targeting Canada and Mexico to start with. And we expected the administration to continue down this path for things like semiconductors that are used in a lot of computers and around artificial intelligence, pharmaceuticals, and other things like copper and timber. But we really expected something like a broad 10% tariff on all countries for the goods that are imported into the US. However, on the 2nd of April, Trump announced much broader tariffs, with specific tariffs to over 60, to applying to over 60 countries, where there are trade surpluses to the US. And that's where the US is importing more goods from a country than the US is exporting to that country. And this is what they're calling a surcharge tariff, which is up and beyond the 10% already applied to each country. And it was really this final piece that was really unclear and has spooked the markets and created quite a lot of volatility in recent weeks. The share markets in particular around the world have been riding a series of waves, essentially due to that uncertainty. KiwiSaver balances will be down at the moment, but you'll probably find it's not nearly as dramatic as the headlines will suggest, depending on how you're invested and your risk profile. And from the last week, it was really bad news. And then today, the message changed completely, and the markets had a huge update. The Standard & Poor's 500, S&P 500, which is the largest 500 companies in America, was up 9.5% in the day, and the Nasdaq, the technology index, was up over 12% today. And to put that into context, that's the third best single day in the market since World War II. And then following that, Asian and New Zealand, Australian markets have followed suit and are all up strongly today. So a bit of perspective around the headlines you read and hear about on the radio and TV. The US share market, which is referenced every day in the news, it's currently down 7.22% since the start of the year, which is not as dramatic as the headlines would lead you to believe. And if you measure where it was 12 months ago to now, it's actually up 7.16% as it today from 12 months ago. So I just wanted to put a bit of perspective around that, because I think we often get fueled news and headlines which, don't always line up to some of the actual realities. But it's really impossible to predict what the direction is right now. Share markets like certainty. They like certainty around the companies that are in the share market, their performance, their future plans, their forecasts and their people, etc. And markets also like to understand the economy and how the economy is being impacted by things like monetary policy, like what we heard today with the Reserve Bank in New Zealand announcing a cut in the official cash rate. And they want certainty around government policies. And right now, what Donald Trump is doing almost on a daily basis is injecting uncertainty into markets. And markets don't like this uncertainty. And unfortunately, at the moment, those who are trading in the markets have really needed to have their head on a swivel trying to keep up with the daily announcements out of the White House. So the news isn't all as bad as it's made out to be. There's certainly some challenges at the moment, but that's what we face into regularly.
I know it is, isn't it? That killer uncertainty that just keeps coming through, because we'll even sometimes see the markets respond positively to sort of bad news, just because at least they know what's coming then and they know how to plan. And what we've seen today is even when we've had good news, so to speak, of Trump rolling back many of those tariffs, that has had a really positive response, but it's still really hard for the business community, for the markets to deal with that uncertainty, right? There's still that uncertainty hanging over everything.
Totally, and that creates this fear and concern that we hear from our customers, that and we understand. And that's why we're running the session tonight. It's trying to work through some of that uncertainty, and yeah, it is difficult with what we're fed, and as well as what is coming out of the United States at the moment.
Yeah, absolutely. Well, on that, one of the questions we got sent through was someone saying, I've seen my balance go down in the last few days. Will this continue and how long for? So, Aaron, how's your crystal ball looking?
Yeah, and that's the central question right now. How quickly will this uncertainty disperse? And how will the impact of tariffs play out? And where will everything ultimately land? And that's what the market's trying to figure out. Market analysts are saying that we should expect volatility for the next days and weeks ahead. No one's saying this is all settled and it's smooth sailing from here. But the key thing to remember is volatility is not a one-way street. Today was a volatile day and markets had their best day in years. It was also the eighth best day in the US share market going back to 1923. You have to go back to 2008 to see a better day in the market. So that's volatility. Volatility is up and down. And we'll see more of these ups and downs until everything settles down, which is why we keep focusing on what we can have more certainty about, which is looking out longer. And that's how we manage our portfolios, looking at forecast and data over a 5-year perspective. Because in investing, the further you look out, the clearer things become.
Absolutely. It's the classic, isn't it? Where you'll see sort of the week of a crazy looking graph, and then you zoom out to the 1 year, the 5-year view, and okay, there's bumps along the way, but it's heading that way. And that's just how the share market has always operated. Yuval, you must have had this from customers. You were saying you were fielding all these calls today, and so I'm sure you've had similar to this question that I've got here for you. Everyone is telling me to stay calm, but I am worried if I do nothing, my balance will keep going down. What should I do? What do you say to people in that situation?
Cool. So I guess the first thing you want to make sure is that you're actually in the right fund, especially for your age, your stage in life, and the risk appetite that you like to take. This is where it's the most important time to make sure that you've had a conversation with an advisor. And if you haven't, we obviously have a wide network of advisors here that are able to support you to ensure that you are in that right fund type. I guess the key thing to remember as well is, yes, the market is currently down. However, similar to what Aaron said, it's not going to stay down forever. And like you said, if we look back at history, the markets have faced many ups and downs that we can remember. And I guess the worst thing that people can do is think that this is so different. We can point to events that have happened over 100 years and look at how markets have initially reacted and then what happened next. And in every event, markets do recover and they go higher. And essentially, that is how markets do work. The events are usually different, I guess, which is important to highlight, but in every instance through history, the market does figure itself out and it does move forward. Sometimes it can do it quite quickly, which it did during COVID, and other times it might just take a little bit longer. I guess during this time as well, it's very natural for all of us to feel very anxious and very fearful during the market downturns, but making these decisions based on our emotions can actually lead to potentially poor outcomes for us long term. I think we need to look back at history. It teaches us some great lessons, and it's a great anchor point when our emotions are starting to influence, our decision making. I guess the key take is remembering that it's time in the market that is key. You don't want to keep trying to time the market. Essentially, you don't want to miss on any crucial returns by missing those upswings in the markets.
Oh, absolutely. What you say there about learning from history, I think that's so important. Aaron, you did me the great favor of sending me some wonderful research earlier this week when I was looking to things for other work that I do with you, picking your brains. And you sent me this fantastic BlackRock report that showed over the last 20 years, the 25 worst days for the market Then 24 out of those 25 times, within 1 month, it was the best day of the market. So that enormous bounce back recovery within 1 month in all but one case over the last 20 years. Now, that to me is an amazing stat that we can look back over history and see that. So very much speaks to your point before about that volatility. It's not just one way, it's not just down, it's also up. So how does AMP's investment strategy navigate and try to mitigate a bit of that market volatility? What's the strategy from your perspective?
Yeah, it's a good question because core to our philosophy, and it's really important that you're talking to customers, and when customers are considering to invest their KiwiSaver or other investments with a provider, they understand their philosophy, and core to our philosophy is diversification. 97% of our customers invest in diversified funds. And they're the funds that range from conservative all the way up, balanced, growth, aggressive. So it's great that our customers are joining us with this belief in diversification because they're doing it. And so when we manage those diversified funds for customers, we really focus hard on getting what we call the asset allocation right. And the asset allocation is the blend of asset classes like shares, like bonds, cash, infrastructure. And we review this every year to ensure it's set up right. And if something radically changed in the world, we can review it whenever we need to. And we do this by looking ahead and forecasting where the economy and markets are headed based on a huge amount of research and data. And these asset allocations are customized for each risk profile. So one for conservative, through to balance, growth, aggressive, etc. And right now we're reviewing our asset allocations. And this is not because of what's been happening in the markets recently. We actually do it this time every year. The timing is helpful for us, though. But in saying that, at this point in time, we do not believe that we need to make material changes to our allocations. And the reason why, even with all this news and change over the last few weeks, and the reason why is because the changes that we've already made, we believe, will help us based on the longer term view of the global economy and markets. To give some illustration to that point, over the last few years, we've been gradually bringing in even more diversification into our portfolios. Last year, we added an asset class called listed infrastructure. We also added a small investment into direct infrastructure. We added New Zealand corporate bonds through many of our portfolios. And the year before that, we added a couple of interesting bond investments called inflation-linked bonds in New Zealand and in the United States. And they're bonds that give you some protection when there's high inflation periods or when inflation is rising. And these particular moves continued to help us deliver strong returns when the market was going up. But importantly, they're now providing additional diversification, which is really important during this current period of volatility. So our investment philosophy and our investment strategy is really designed to maximize those benefits of diversification. And we think we probably have the most diversified funds in the KiwiSaver market today. Our balance fund, as of now, has 6,988 individual holdings in it. I've seen other KiwiSaver funds in the market with 250 holdings. Right now, I'm really and very happy that we have this increased diversification to help our customers, because when markets are volatile, diversification is your best friend.
Oh, 100%. It is the classic rule for a reason, isn't it? That is a stunning number of assets in your fund, by the way. I know I was off screen, but my face went when you brought out that number. That's quite a flex. Dipen, you must have been getting this question a lot, because I know I've seen this question everywhere. So it's really important that we talk about it. Should I continue investing into my KiwiSaver during this time?
And that's a great question that we are getting every day at the moment. The key thing to remember is markets go through this kind of cycle every few years. And every time it happens, it feels like end of the world, right? Yeah, the emotions are very similar. We have seen that happen during COVID-19 in the past as well. But usually, we got to be optimistic and have faith in human race, and markets adapt over a period of time, right? When markets are volatile, when you are seeing your KiwiSaver balance drop, or your other investments as well, just generally speaking, it can be a good opportunity to invest for the longer term as well, right? Think of it like, going to farmers when things are for sale. You would want to spend money at that time. And, the age-old saying, time in the market is more important than timing the market. So, you got to run with the ups and downs that are happening at the moment.
Yeah, absolutely. I know as well that a lot of people are quite worried because that time in the market is something that, for someone in my situation, right, I've got 30 years until retirement. So I'm looking at this and thinking, my strategy is set, I'm rolling on, it's fine. For someone who's close to retirement, that's a little trickier, right? Yuval, what do we do for someone who's in that situation where they're getting close to retirement or, maybe even really coming up on it? Do they need to change the plan? Is there a good strategy to help them at a time like this where there is less time?
Great question. And my advice is stick to your plan. Okay. Stick to the plan that you have got. Don't all of a sudden make all these changes. If you're sitting there and you don't have a plan, this is your time to make sure that you do seek out that advice and connect with our advisors to make sure that you do have a plan for that retirement phase. I guess what's also important to remember is that we are still going to live in retirement. So maybe you're retiring soon, but fortunately or unfortunately, whichever way you want to look at it, you are going to live a lot longer. Okay, based on life expectancy rates in New Zealand, you have close to 30 years to make your money last in retirement, especially once you hit 65. So you've got time. You've got a decent period of time to recover from things like this and make that retirement nest egg last a bit longer for you. It's also good to remember that if part of your plan is to pass on some of your wealth to your children, your grandchildren, you also want to keep growing that wealth so you can leave that legacy behind. A really interesting statistic that I saw recently said that over the last 20 years, 24 of the 25 best days in the US market occurred within 1 month of the 25 worst days. I guess the point being of that is if you change your strategy now in the middle of what we would call quite a messy time, you might miss the recovery that can happen. As Aaron mentioned earlier as well, today in the US share market, we've essentially had the third best day since World War II. So the point is stick to your plan, stay invested, occasionally check in with your advisor to ensure that your strategy is the right strategy to achieve your retirement goals and your aspirations as well.
I love it. Those are really good points. I mean, I know it's that temptation, isn't it, to say, but this time is different. But they talk about that being the most dangerous phrase in economics for a reason. History may not repeat, but it rhymes. We can really look back and learn some things there. I mean, Aaron, when we do look back at history and we're trying to learn those lessons, what can we apply here? And how long might we think it takes for markets to recover a little bit this time around?
Yeah, I love looking back at history and market events because I think it puts some great perspective on any challenge you're dealing with at current point in time. How long? As I mentioned before, it'll depend on how quickly the uncertainty disperses, but it will at some point. Maybe not in the next few weeks. No one can be sure. But as we saw across the world today, a spark of optimism can change things rapidly. And as I said, I expect this will be a bit up and down for a while yet. History can teach us a huge amount. At the most simplistic level, down markets are always followed by up markets because they're generally either up or down. But picking the peak of the market or the bottom of the market cycles is extremely hard. Again, history tells us that what happens after a peak or a trough in markets. To illustrate, markets have corrected, and we call it a correction when they've moved by 10% or more over a period of time. But markets have corrected by 10% or more 10 times in the last 20 years. So this happens more often than you probably remember. And if you average the performance of markets over the next year following the point they hit the bottom, the average return coming back up in the following year is 24.5%. So history can be a good light guiding us for when we can't see the future clearly.
Oh, 100%. Now, just a reminder for those watching, you can get your questions submitted to our panelists to have them answer live. So if you're listening and we haven't addressed your question yet, or maybe it's sparked something else that you're thinking about, drop those questions in now. Make sure that we use this time to get those questions answered for you, because we really want to make sure that this is a time for getting information, facts, not fear. So drop those in while we're having a good chat here. Now, where did we get to here? Yes. Depend. There is, of course, we keep saying, that you can talk to an advisor, that you can stick to your plan, that you can, do all of these things to make sure that it is actually addressing your situation. So, how is AMP able to support customers if they're unsure of what they should be doing?
Yes. Now, we are passionate about helping Kiwis with retirement savings and their investments. Our whole business is built around this, and we are oriented around this purpose. Now, we have experience in managing investments during uncertain times, similar to what we are seeing right now. We keep our customers updated about what's happening through updating our website and keeping informed through emails and communication around that. We have a really good team of dedicated advisors that our clients can speak with, and they can provide tailored financial advice in it for their individual circumstances. And this is where we are there to help our clients.
Yeah, perfect. That's really important, isn't it? Now, we've got some great questions filtering through. Do drop in more questions as it comes. Let's make sure that we are getting these answered for you. I'm going to jump into David's question here. David says, I'm 61 with my KiwiSaver and pension in growth funds. I'm just gritting my teeth, trusting that the markets will rebound and grow beyond the recent losses. There's so many examples of people who shifted to conservative funds and then missed out on the rebound. Sorry, that's a comment rather than a question. Yes, but it is nice to hear what people are up to. Aaron, I'd love to hear your thoughts on that. I know it was, as he says, a bit more of a comment than a question, but do you have any thoughts on that?
I think the final bit there are a lot of people during uncertain times who switch their balances to conservative funds, and quite often down the track they regret that decision. And that's not to say it might not be the best decision to make, but you want to make that decision, getting some advice, considering all of your goals, what you're trying to achieve, your stage of life, etc., to make that decision. Just making that decision in an uninformed way has risk, because if you do that after a period where markets are down a bit, switching it to something more conservative, really lessens your chances of recovering what you're down on. So key thing there: get advice, make sure it's the right step for your stage of life, your goals, your aspirations, everything else that's in your plans, and then make the decision that way.
Absolutely. Now, Yuval, there's a question here that's also got 2 thumbs up. So I'm assuming that both of those other thumbs up are from other people. So 3 people, I think, have this question at the very least. And they say, you've spoken about people leading up to retirement, but what advice do you have for those currently retired and relying on the income from our investments? Have you had any clients contact you with that? What have you been telling them?
Oh, great question. Look, it's essentially, as I said earlier, the best thing is to, stick to what your original plan was. What I will do is, Diffin, I know you've had this question quite specifically recently, so I'm going to rugby pass it your way, as I know you can answer this one perfectly from a call that you did have today.
Perfect.
Thank for that, Yuval. Now, in retirement, when you see your balances go down, it can be unsettling, right? That's understandable. The key thing here to remember is, you take a step back and think, when are you planning to use the funds? And as all of us are living longer, mid to high 80s, if you retire at 65, you still want the money to work harder for you for those 20 years in retirement. So we have a really good team of advisors that can help you structure your portfolio in terms of different funds that can meet your goals in the short, medium, and long term, and so they can help you around that as well. And I think, Aaron, do you want to add something on this?
Yeah, I think a point I'd make here is that people often think that their nest egg, their savings in retirement need to generate all of the income that they want to supplement, the other incomes, their pensions, etc. Having a really good plan around being able to draw down your capital, draw down your savings, rather than just trying to drive income from it, is a critical part of retirement planning. So again, figure out with an advisor what the drawdown plan can look like, because just relying on income, unless that's all you want, there's so many people that do not spend their retirement savings, and really having a good plan around spending your retirement savings is just as important as the plan you have to build up those savings in the first place. So yeah, think about that, and talk to one of our team that can really help with retirement planning and retirement spending.
Yes, I remember it's a story that actually made me a bit sad, where someone told me about they had gone on a big family holiday recently because elderly relative had died, left them a lot of money, and this elderly relative had actually never left the country before. And then with the inheritance that they left behind, the whole family went on holiday together and remembered them. Now, beautiful story, and they told me it as a lovely story, but I couldn't help but think to myself, I'm so sad for the person who died and never left the country, and everyone went on holiday without them. So I think you are spot on that it's also really important to have a plan for spending your money too. That's really key in life. There's another question here that's got a lot of thumbs up. So obviously it's hitting a chord with a lot of people. So I want to answer this one. Aaron, I'll come back to you on this. And then we might also get your thoughts on it too, Yuval, after Aaron. If I have spare cash, is it a good time to put it into my AMP KiwiSaver now, or even buy shares myself somewhere like Sharesies if that's a quicker way to capitalize on a lower share price? Basically, I think they're talking about buying the dip there. Aaron, what are your thoughts?
Yeah, good old buying the dip. Well, the last point first. We're buying shares at the same prices, if not better prices, than what you're going to buy them through Sharesies or something else. So the fund itself has a lot more buying power. So shares that we're buying today, we're buying on market at lower prices than they were last week. So through your KiwiSaver or other savings vehicles, you're getting the same benefit of buying the dip or investing. It's really hard to, as I said before, try and pick the bottom. So if you're looking to invest a lump sum at the moment, probably an approach to consider is exactly the same as people that are saving into their retirement savings do in KiwiSaver, just being adding to the market regularly over a period of time. So those that are saving in KiwiSaver or other saving vehicles, keeping those contributions going through this time is really important, because you are buying assets at lower prices. And as Dippin said before, it's like going to farmers and things are on sale. So you want to keep doing that if you've got regular contributions, but if you are looking to invest a lump sum, you might want to just consider the same approach by just drip feeding into the markets rather than trying to pick a perfect time.
Yeah. Yuval, what are your thoughts? Have you had people getting in touch with you saying, actually, is this the right time to buy?
Yes, yeah. I've had a few of my close friends decide to give me calls and tell me what should I be doing. And yeah, I'd echo pretty much what Aaron said. So yes, if you want to, definitely yeah, like I said, drip feed and buy a few of those. But if you can contribute more to your KiwiSaver overall, I always encourage that, a lot of people do the 3%, but if you increase it just to 4%, that significant long-term outcome that you can have from that. So that's always a little tip that I like to give my friends. If you can add a little bit more to that KiwiSaver, definitely go for it. If you can add a bit more and say you've got the house goal, the retirement goal coming up, definitely put a bit more money if you can.
Yeah. Dipan, we've got a question here that is kind of the flip of this. Someone who is looking to avoid the dip, I think, where they say, in times like this, if we stay in our current fund, but possibly look at reducing the percentage paid into the fund, e.g., I'm thinking about dropping 10% down to 3% and keep more cash in your pocket in the short term. that's sort of the opposite strategy, isn't it? Someone who's nervous about having money in the market. What would you say to a customer who's talking to you about something like that?
So the key thing over here would be to take a step back and think about what your plan is, what your goals are, and what your risk profile and the investment time frame is. Timing the market is very hard, right? As we would have seen just today, all we were reading for the last week was the markets have gone down by an X percentage. Today in US, the overnight their markets went up in a day by 10%, right? So it's very hard for people to time the market. So if you reduce the contributions, you might miss out when the markets go higher as well. So it's, when you are contributing at the moment, you are doing what's called dollar cost averaging. In times like this, it's more vital to continue your contributions if you can, depending on your personal circumstances, which our team can help you with.
Absolutely. And that's the wonderful thing about having experts on board and helping you with your money. Yuval, one of the questions that got sent through, we've talked a lot about diversifying, about getting into funds, things like that, so that your money is spread across lots of different markets, lots of different companies, lots of different industries. So are there funds that are better to invest in when times are a bit turbulent like this?
Cool, great question. So I guess, like I always say, so stick to the plan that you have. You don't want to chop and change which fund you're investing in based on what's happening in the market. If you are maybe similar to me, I've got 30 years, for example, before I'm going to retire, giving my age away there. Essentially, I'm not going to change my strategy because I have time to ride those waves. If you do have that short-term goal, hopefully your strategy that you're in aligns to that as well. So you should not be chopping and changing because of what's happening. I always say stick to the plan that you do have, and essentially that should help you ride the waves that are currently happening. Aaron,
Yeah.
is there anything you want to add there?
Yeah, because I tick a different age box than you, Yuval. And so I don't have 30 years, but I'm not changing my strategy because it was a strategy I had before. Nothing that's changed in the last weeks or months, necessitates me changing that strategy. And that's the same how we invest the money in the funds. We've got good diversification. If you're in a diversified fund, as I said, 97% of our customers are already, you're in the fund that suits the risk profile for your plan, then we're taking care of the asset allocations. We will diversify the funds as we say we're going to, and the diversification across many different markets, many different types of securities, because it's not just all in shares. We've got bonds at the moment which are going up in value. We've got some shares that are going up in value, infrastructure that's going up in value. So not everything is going down. As I said before, you've got to be a little bit careful that the media and the headlines you're hearing about are not sort of driving emotive behavior. Because, unfortunately, when you're influenced by emotions and they're natural, fear, and sometimes greed, then it gets in the way of logic and good investment strategy. So probably similar to the Dippin's analogy before, if you go into the supermarket and see cans of Waddy spaghetti on sale, what do you normally do? You'd normally buy two of them instead of one. And right now, maybe you should be increasing your contributions and buy more. But unfortunately, the human brain is wired in some particular way that it doesn't think like that when it comes to investments, but it's exactly the same concept. So, keep to the plan, keep to the strategy, keep that diversification.
Yeah, solid advice there. And we've got a couple of questions here that I think I'll send your way, Dippin. I'm just going to wrap them into one because we've mentioned the importance of financial advice. So the first question says, are financial advisors available after hours or only during business hours? I can't get any time during working hours to do that. The second one says, do AMP only provide advice to the customers? How should I seek advice? Dippin, what can you say to that? How do people best get advice?
So generally speaking, our advisors are working till 5 o'clock. But if you need help, in times like this, we will be happy to try and help you by managing our personal circumstances as well. So someone from the team can try and help you after hours if that's what will help you as well. Just get in touch with us, and we will try and work with you around that. And in terms of, that's the if you are not an AMP customer, we will be happy to help you in terms of your circumstances. If you are planning to have funds at AMP or investments at AMP, we will be happy to help you around that side of things as well.
Fabulous. Yuval, you have any thoughts on this one?
Yeah, just to highlight what he said, essentially, we have dedicated teams. We've got the phone-based team, but also have a face-to-face team that go around. We have a nationwide network of advisors that go to different workplaces and connect with lots of different customers. And you definitely don't have to be with AMP. The key for us is to make sure that you do get that advice from our fantastic workplace team as well. So there is support out there for all of you from us. We can ensure that when we send the communications after this, that we make it really easy for you guys to connect with us and to ensure that you get the support that you do need.
Love it. Aaron, some final thoughts from you. I know I've asked you to look into the crystal ball a couple of times, but when you're looking into it, what are you expecting to see in the next few months in the markets? What is your best educated guess?
Well, I wish I did have a crystal ball and could tell you with a little more confidence. We're going to have to be patient and see how this global trade issue plays out. Trump has changed the game almost on a daily basis. And until we get certainty on where this lands, it's going to be hard to be confident on the next few months. There will probably be a period of governments and companies considering what these policies mean for them. Companies will be looking at their revenues, at their profit forecasts. Central banks will be looking at economic growth and inflation and considering settings for interest rates. And governments will be looking at their fiscal and trade policies depending on where everything lands. So there's a bit to work through, and we do need to be patient and let this play out. It will play out. Things will recover. They always have before. We think that in time, or in a little bit of time, the US is going to sort of regain their leadership position of global share markets back to where they were a few months ago. And that's really been led by large mega forces. And we like talking about the mega forces that are going on at the moment, things like artificial intelligence and infrastructure investment. And that will come through beyond following, the situation at the moment. But it may be a period after 3 to 6 months of policy uncertainty and until that sort of plays out, and then we get a full understanding of the landscape and where everything's sitting from there.
It's very, very good analysis there. Thank you, Aaron. All right. Well, we've talked about a lot. We've covered a lot of ground. We're running out on time. What I really want to do is we've all got short attention spans these days. If there's only one thing that people listening take from this webinar, one key thing that you think that we need to hold on to, what would that be? And I'll start with you, Aaron.
Well, we're going to stay close to our customers. We'll continue to update you on the situation through our normal communications, through our website, and through our team of advisors here. And they're there to talk anything through. And as we said before, we just urge people to reach out, have the conversation, get a little help before you make any changes to your funds. But we're going to stay close, and we're going to help you through any uncertainty and times, and there'll be more in the future, no doubt.
Yes, I'm sure there will. It always seems to come round again. What about you, Yuval? What's the main thing you hope people take from today's session?
I'll keep mine short and sharp, but essentially the very classic Kiwi way. I would just say keep calm and just carry on. We can all do this together. We'll ride these waves, and we've got this. And AMP is always here to support you guys along this journey.
Fantastic. All right, Dipen, your turn.
Thank you. Now, when markets go down, it generally always feels like it's the end of the world, right? But typically what's happened over the last 100 and 150 years is markets do recover over a long period of time. We at AMP have seen similar situations and have helped our customers navigate this uncertain times. if you are thinking of doing anything in relation to your funds, please give us a phone call or an email before you think of doing anything, so we can help you and our advisor team can help you through it as well.
Yeah, wonderful advice there. And I think the big takeaway for me after listening to all of this wonderful expert advice is really sticking with the plan that you've set. So often it seems to come back to the plan that you set is more reliant on your own situation than whatever is happening in the headlines at the moment. So hopefully you set a plan at the beginning, things like this were factored in from the beginning, and you just keep going with it. I think that's the big takeaway that I'm taking from this session. Thank you all so much for your time. Aaron, Yuval, Dipen, taking the time out of your evening to give us some good, solid facts to cut through the fear that has been happening. Really appreciate it. Now, for anyone who's been listening to this, this is not the only time that you can get in touch with AMP. This was just a good time for us to be in touch live, get those questions through, put some faces to names. But you can keep getting more information. Keep an eye on the AMP website. You can talk to your advisor if you're worried about anything else or you have further questions. And there will probably be more information coming your way after this session as well. Not least that the replay of this session is going to be sent out to everyone who registered. So do enjoy that. Thank you so much for tuning in. Really appreciate your time. Thank you again to our panelists. What a brilliant session that's been. Have a lovely evening, everyone.
Thank you.
Thanks.
Thank you.